Hello, and thank you so much for joining this YouTube channel. Kindly remember to subscribe if you are new here. If you are a continuing subscriber, kindly share this page to your friends and let them subscribe. So today we are going to look at the moving averages, and my name is Kirui. So when we talk about the moving averages, it is simply a way to smooth the price action by filtering out noises from the random fluctuation in the price. And this moving average helps us to determine the general direction of the market, the general direction if the market is going on a bullish direction or if the market is going on a bearish direction. So this moving average, it talks about averages and mean. It means what? Here we will be doing mainly averages of how the price has been behaving at a particular period of time. So when we talk about the moving average, is a trend following indicator, and when we talk about a trend following indicator, it means that that indicator will be lagging behind the price. Why do we say it will be lagging behind the price? This is because its judgment or the lines that it will be, this moving average will be drawing, will be based on the past price action. It will not be using the current price action. If you are at a 1 hour time frame, your moving average will be 1 hour late. If you are at the 15 minutes time frame, the moving average will be 15 minutes late. Why do we say it will be 15 minutes late if you are on a 15 minutes time frame? Because the 15-minute candle has to close so that the moving average could use the closing price. Okay. So this moving average also is used to determine the support and resistance level. And we are going to look at the two types of the moving averages. We have the simple moving average, and also we have the exponential moving average. So we are going to learn about this difference in a few minutes. We're going to look at this difference in a few minutes. So, so we have the simple moving average, and the simple moving average is just calculated by adding up the last period, the last closing period of the price, and dividing it by the number of periods that it is covering. And this type of simple moving average is the simplest type of moving average in Forex. And also this simple moving average reacts slowly to price. It does not react very fast. So if you have a price that made a very huge spike, you will expect the simple moving average to really react slowly to the price. So also, the longer this simple moving average period is, the more it lags behind. Why? Because if you are covering very many candles, and remember, the simple moving average will be adding the last closing period of a price and dividing them by a certain number of candles. So it means if the period will be long, it will mean the price will react very slow and it will be lagging behind the price. Okay, so these simple moving average are very susceptible to spikes. It may give you poor judgment if you will be dealing with it. So there is this also exponential moving averages. We are going to look at the difference. So there is the exponential moving average, and the exponential moving average gives more weight to the current or recent price actions. And also this exponential moving average reacts quickly to the price as compared to the simple moving average. So we are going to look at whatever we are talking about in a chart, in this chart here, and we want to see how the moving average is behaving towards the price. So I'm going to erase all these drawings that are on my chart so that I can work with a very, very clear chart. So here, if you are using a trading view, you just come to these indicators, just come to that indicators, and you just type moving average. moving average. So since we want to see the difference, I'm going to type the simple moving average. So we have here simple moving average. So whenever I've just clicked the simple moving average, it's giving me a lot of moving averages. So I have to remove some. I don't want to give all this. So I'll remove this. We want to remain with only one simple moving average. So we have that one. So as you can see, the simple moving average applies to only where the price closed. It only applies to only where the price had closed. Okay, so if it applies to where the price had closed, it does the average of where the price had closed. So now also, let me take you again back there. So also remember, as we were doing the input here, the first one here is the number of periods that you want your moving average to cover. So when I say 20, it means 20 candles going back, 20 candles. And when I do 2 candles, it will mean only two candles. Okay, I want you to see the difference. If I'm using 2 candles, the price will react very quickly to the price. But if I use a longer period like 50, the reaction of the moving average to the price will be different or will be slow. Let's look at it. I've done the 50. Look. I've done the 50 EMA. When the price was having this huge spike to the higher side, our moving average didn't move up. It was just lagging here. Okay? It was just lagging at this place. Now, compare this to when we were doing our moving average with a period of, let's say 5 periods, 5 candles only. Look at how the price was responding. Look. You see? So what does this simple moving average do? Look, as this price was going up here, it closed here. So it takes the value where this price had closed at. Let's say this price had closed this price had closed here. So it takes the value of this place. That is 1.34544. It adds that one 1.347, 1 point this, 1 point this, 1 point, it add all of them and divide by, if you are doing 5 periods, it will add and divide by 1, 2, 3, 4, 5. So it divide for that one and it give you up to this place here. If you go to the next candle, it will be coming back 1, 2, 3, 4, 5. It will not go to this previous one and to do the divisions of it. And this moving averages is continuous. It does from backward and coming forward like that. Okay, so that is how the moving averages will be behaving for simple moving average. So now let's look at the exponential moving average. Exponential moving average. So this moving average exponential, it is shown in our chart. So we want to go to settings, we see how it behaves. So exponential moving average, it is called also EMA, and you can see it applies to where you see the length, the number of periods it covers. Source, where do you want to cover? So for exponential moving average, you can now place to do the average for you for either open, high of the candle, low, and close for the candle. So it will covering the highest that candle that want to, the lower that candle that want to, the close and the open, and they do the average of all. You see? So Just click like that, and it will be doing the average of this high, this close, this one, and this one. So you see, it gives more weight to what happened. And when that is happening, you see as like this candle is here, there is a place that it had opened, and there is the highest it had went, and there is the low it has reached. So it will be doing all those, meaning the reaction to price will be faster. I want to do 20 EMA, and also we do 20 SMA. So I'm just going to put the length 20, and I click OK. That is it. I want also to go to SMA, simple moving average. Simple moving average. Simple moving average. I want to use the one that is alone. So I'm going to remove the rest. So I want to see now this difference. As you can see here, this is the simple moving average. Let me put the simple moving average color to be red. Put color to be red. Thickness to be a little thick. And I click OK. So now look. The reaction of the simple moving average to price is very low. Look. When the simple moving average, the exponential moving average was reacting a little fast to price, it was showing the price is going up. Look at this one, it was behind, not very much closer to the price. Now, even let's look if we do more settings on our simple moving average. You can do high, low, close, like that. We see how it responds. You see, it is highly reacting to price compared to the simple moving average. Look at this area here. Still, the simple moving average is still showing me that the price is having a strong momentum when it was here, when it was at this candle. But look at the exponential moving average, it already showing you the price has changed direction. As much as the moving averages is lagging behind all of them, the EMA reacts more faster or more quicker to the price compared to the simple moving average. Okay. So that is it for the simple moving average. I want to show you how we can use so now we will consider using the exponential moving average, the EMA. We want to see how the EMA will be acting as support and resistance. How the EMA will be acting as a support and as a resistance. We want to see how the behavior of how is it going to behave, or how is it going to react to price. So let's look at this. Sorry. So this area. So now let's look. When the moving average is below the price, it is at the area where it is acting as support. And when the price is below the moving average, it is acting as resistance. So we are going to look at the both scenarios. We want to look at this scenario here. So here, as you can see, the price, this simple moving, the moving average here was acting as a support. And the price, when it came to that moving average, it hit it and move up, hit it again, move up, hit it again, move up, hit it again, still continue to go up. Now, when are you going to determine if the support has been broken? When we have a major move that moves below that moving average. That is when that moving average turns from support into a resistance. So let's look at what happened in the past here. It was happening in this past. So let's look at from this area. So this moving average here was acting as a resistance to price. So as you can see, the price came down, went, test the moving average, it was rejected, came down, test the moving average, it was resisted again, tested, resisted, tested, resisted, tested, it was resisted, like that. So it depends on the periods, the number of periods that you are dealing with. If you are dealing with 50, it will be reacting even more to 50 compared to 20. Let's look at how it was responding to. This was when it was acting as resistance. The price went to it, it was rejected, went again to it, rejected, went again to it, rejected, went again to it. This is when it broke it and acted as support. Then whenever it is being broken, we have a sharp move, then it acts again to test, like that. So you can use these moving averages to support and resistance. I don't trade using the moving averages, and I always prefer to use market structure, and that's why you don't see me talking about the moving averages, crossovers, and things like that. Unless you will be requiring it, you can comment on this page, and I will do that one for you. Thank you so much for joining us. I hope you will be able to practice so much on your charts and also be able to make good judgments about the charts and things like that. That has been has reached the end of the Forex basic course. I'm going to do I will help you to do the live trading, and also we can put all this together in the next video. Kindly remember to like, share, and subscribe to this Forex Express. Thank you so much.